My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. When the book is written on the market's performance this month, there will be one lone hero, one company that launched rallies in hundreds of good stocks. And that savior was none other than the failed Silicon Valley Bank. Rallies that included today. The Dow gained 323 points, S&P jumped 1.42%, and the Nasdaq pole vaulted 1.79%.
House of pleasure.
Yep, the useful idiots at the helm of the previously smart merchant bank set off a domino-like financial catastrophe, and we have to thank them for it because the crisis stayed the hand of the most aggressive Federal Reserve in 40 years. Without the overnight collapse of Silicon Valley Bank, we might have been hit with an additional 50 basis point rate hike on top of the quarter point we got last week. That's how hot this economy remains. And I bet the averages would be substantially lower than they stand right now. Instead, we've been enjoying a rally centered around the Nasdaq, of all places, that's left behind so many strategists lost in the weeds of something abstruse and allegedly all-knowing, and it's called the yield curve. These thumb-sucking economists care so much about the macro, yet somehow they're always missing the big picture. What a bunch of gas bags. They must be paid by the word, certainly not by the capital gain. They know nothing! Nobody can blame the Fed for slowing down the pace of its rate hikes. Until a few weeks ago, we didn't care that so many banks had taken their COVID-boosted deposits and invested them in the longer-term bonds that were practically guaranteed to take losses in the event of aggressive rate hikes, which we got. We didn't have a clue that old-fashioned bank runs could happen so swiftly. Who knew that a bank like SVB could have a deposit base of venture capitalists, billionaires, by the way, often, that wanted their money back all at once because they hadn't been able to bring their portfolio companies public in this comatose IPO market. We saw billions of dollars exit with a couple of keystrokes, and practically overnight, this fixture of a merchant bank just vanished, leaving legions of panicked depositors in its wake. Suddenly, corporate treasurers felt compelled to pull their money from the regional banks and put it in the safest place around, J.P. Morgan, a couple of other titans, because why take the risk of a bank run? Only $250,000 in insurance. But when you go through all the ramifications of the SVB failure, they actually end up breaking positive, not negative, for much of the stock market, all because of the Federal Reserve. A month ago, the Fed was fighting one more, the war against inflation. Then we got an instant financial crisis, so suddenly they also needed to worry about bank runs, which are the most deflationary force in existence. So what's happened in the wake of Silicon Death Valley? First, investors dug up the playbook of what you can buy when there's an economic slowdown without high inflation, because that's the typical result of a credit crunch. In a sluggish economy, the Wall Street playbook says you buy tech, but not just any tech. You buy tech that's brimming with cash and doesn't need to tap the equity or bond markets. Pristine techs that have so much money, they actually look like banks, without all those pesky risks of running a bank, credit losses, tellers. That may sound like a weird way to invest, but you know this show is about pulling back the curtain so you can find out what's really going on, and you need to understand that this is truly the way money is managed in this country. And the great thing about trying to figure out which stocks to buy in this new scenario is that they're already chosen for you. Yep, you go after the most obvious big-name techs that are carrying around boatloads of cash. For instance, you go with, of course, Apple. Today, people lapped up the launch of Apple's Buy Now, Pay Later service, where they'll advance you anywhere from $50 to $1,000, then you pay them back in 4 installments. Oh, it's a nice hook. The news actually broke, though, yesterday at 11:30 a.m. No one seemed to care then. See, the real reason Apple stock keeps going higher is because the bears, they have run out of ammunition, at least for the moment. They tried to float the idea that the service revenue is slowing, and that didn't work. They circulated the usual surfeit of component supply surveys. Pushbacks from a lack of demand fell flat. They even went with the sales hurt by the China Cold War thesis, something that didn't hold up under close scrutiny given CEO Tim Cook's rapturous appearance in the PRC this week. Any of these stories might have wrecked that stock last year, but this is now a market where Apple gets the benefit of the doubt, again, thanks to the First National Bank of doofuses. Of course, Meta, whatever, was able to put on a good show, too. What a remarkable moment. Think about this. Mark Zuckerberg, perhaps the most reviled man to testify in front of Congress, at least if you exclude the bankers, has managed to beef up his TikTok killer reels just when Congress wants to backhandedly do his bidding by threatening to block the Chinese-owned TikTok. He's the Manchurian Meta candidate. At the same time, Zuckerberg's laying off people left and right, which is exactly what this market loves. No wonder the stock's been a huge winner. But then, seemingly out of nowhere, unless you watch this show on even a cursory basis, NVIDIA managed to steal the stage. CEO Jensen Huang's annual keynote address happened to come exactly when the banking crisis struck the most fear in the hearts of many a distracted investor. They missed the moment when the man I call the modern-day Da Vinci unleashed a technology that may be as revolutionary as the cell phone, the internet, and maybe even the wheel, certainly the helicopter. I am talking about generative artificial intelligence, or AI. In one brilliant 78-minute lecture, Huang showed us how AI could be immediately added to the bottom lines of the likes of Microsoft, Adobe, Oracle, all apostles of the NVIDIA gospel, among so many other companies. The event was tailor-made for them. It produced a NASDAQ stock bonanza.
That was easy.
But that's not all. Chaotic moments like we had in the wake of the Silicon Valley Bank, Silvergate, and Signature Bank, the three stooges of banking, tend to embolden short sellers. They sense that a slowing economy would bring about a hobbled consumer and a weakened housing market. Larry, Mo, Curly, Shemp, even Joe couldn't resist trying to take advantage of this bank bloodbath. So naturally, they targeted stocks like, let's say, Cintas, okay? They reported today. It's an outfit that supplies uniforms to small and medium-sized businesses because isn't business getting weaker, right? Isn't that what's happening? Stock worse 21 points, or about 5% on massive beat. Oh, they honed in on Micron, the bedraggled commodity chip maker. A bottom beckons, and next thing you know, they're squeezed for a 7% gain. They gun for expensive retailers like Lululemon, and they are gaffed for 40 points, or 12%. These were all great shorts, in theory. But in mad money, we're talking practice. They shorted these stocks, unwittingly issuing invitations, yes, indeed, to their own funerals. Finally, the pessimists reached for the stocks of companies they would assume would experience a slowdown in orders from the inevitable credit crunch, a credit crunch that frankly hasn't surfaced yet. I'm talking, say, Caterpillar, Illinois Toolworks, classic cyclicals that normally get blasted to kingdom come in a slowdown. Now they have to average up or cut their losses. You know what, guys? Do the latter. Oh, and let's not forget customer relationship management kingpin Salesforce, with CEO Mark Benioff knocking off not one, not two, not three, not four, but five activists with a slingshot and some amazing earnings. Benioff's a collateral winner. Silicon Valley Bank was nurturing some competitors that have just had their oxygen turned off the oxygen. Toto. Now, I'm not saying these events wouldn't have happened if not for the bad bank domino theory, but I think they would have been interpreted differently for certain. Yep. Fewer tech stocks would be getting the benefit of the doubt if the Fed hit us with a 50 basis point rate hike and a few hikes more, which may well have been in the cards without the bank runs. Of course, we don't know what lurks in the banking world. People keep shouting from the rooftops that Schwab's next. I mean, wait, Schwab, that's one of the most ill-advised positions I've heard. And as I explained earlier this week, it's a good stock. First Republic, apart from a distant, they think that's a distant resemblance to SVB? I don't know. Certainly we could come in tomorrow and find some ne'er-do-well bank grasping at federal straws. There's one thing we know for sure, though. This banking crisis has spooked the Fed, and that's allowed all sorts of growth stocks to come back in style on, yes, indeed, the Wall Street runway. The bottom line, this market may be mindless, but it's got muscle memory that says you reach for tech in a slowdown. The Silicon Valley Bank fiasco was just the oxygen that tech bull needed to snap out of its funk and get back to work in time to give you a nearly 14% gain for the NASDAQ in what's looking to be the 3 months that fooled the world. Dale in Kentucky. Dale.
Booyah, Jim. Thanks for taking my call.
My pleasure. What's going on?
Hey, got a question for you. I'm invested in a company that I know they do a lot to help reduce carbon emissions in hospitals and factories and schools and such. What's your thoughts on training technologies going forward?
I think those guys are good. I'm going to give them a twofer. I think you get a twofer. I'm going to throw in Carrier because I like what they're doing, too. So that wasn't just one. I gave you two. How about Zimmy in Florida? Zimmy!
Mr. Cramer, what's happening?
Not much. How about you?
Oh, just living life in Florida. But, like many
All right, so you
regional
got the edge
investors
of me.
out
You have to
there.
rub it in. He has to rub it in. He's in Florida. I'm here in New York. What's up?
Yeah. Just like many retail investors out there, I got in at Tesla at probably around like $30 a share. And given that our boy Jerome Powell is looking like he's going to cut rates later this year due to a recession, is the time now really to sell Tesla?
No, and let's say the one thing that's great about Tesla, we don't need Jay to make money because we got Elon, and Elon is real, and he's great. By the way, you're in Florida, I saw a launch. Go see a launch. It's mind-blowing. It was one of the greatest things I've ever done. Let's go to Paul in Texas. Paul.
Booyah, Jim.
Booyah.
I'd like to discuss some homework I've done on Syneos Health, ticker SYNH. Now, I know we shouldn't buy a stock for a takeover bid, but this one's really interesting.
No. Well, tell me what's interesting about it. Oh, because, the reason I say that is only because it's like I myself have to do something about it. I don't understand how this stock could be so cheap. And usually when there's something this cheap, it means there's a story behind it. So we're going to come back and we're going to learn what's really going on. All right. When it's all said and done, the blow-up of Silicon Valley Bank may play down as the market's saving grace. And not a moment too soon. On Mad Money tonight, Macy's CEO Jeff Gennett announces plans to retire in February of next year. And I'm learning more about the company's succession plan with the man himself. Then earlier, I had a chance to talk to GSK CEO Emma Walmsley as part of CNBC's Healthy Returns Conference. And we're showing you a piece of that interview that you do not want to miss. And Paychex has its finger on the pulse of small, medium-sized businesses in this country. So where does this corner of our economy stand with regional banks in limbo and the Fed on a mission to tame inflation? I'm digging into the details with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.